All right, everybody, welcome Doug McKay, antiwallstreetguy.com, on the 1st of June, 2012. This will be the fifth video in a row, which will be the fourth week in a row. We have the overall trend in the equity markets is down. Again, just to go over what we covered before, if you're joining us for the first time, once we broke support in the 50-day moving average, which also occurred on a non-farm payrolls day back on May 4th. That was our signal that the trend was down. We didn't know how long that would last. You never do. Could be 10 points, could be 100 points. This is a daily chart. We will go to a weekly and then a monthly chart. The S&P finished near the lows of the day on an increase in volume, so definitely distribution. I believe it's right at around the 50-day moving average. These are just some notes that we put in on the 29th, the 24th. We thought that if the S&P, even though the trend was down, we thought there was a bounce because this was oversold, that if we got above the line, that would increase the odds that there was a bounce, thinking maybe we'd go to 1350, 1360. As it turns out, it never even made it to 1340. It did close above the line. And then we were looking at a triangle pattern where it broke out of the triangle to the upside, but then it came out of that triangle on Thursday, and then today the jobs number was sold. So we did put here, surprised if these lows put in this week actually hold, still thinking the 200-day is the eventual target. That was put in last week. So that ended up occurring where these lows didn't hold, and therefore we broke those lows and eventually went to what we refer to as a magnet, which was that 200-day moving average. All right, so the overall trend is down 32. The bad news is we did not make any money this week. The good news is we did not lose any money either. Cash is king. Could the market continue to fall? Absolutely. We'll take a look at a weekly chart. And let's go over here to weekly. There we go. All right, I'm going to clean this up a little bit so we can see this more clearly. Bear with me a minute. This is a weekly chart, so if you're not a technician, the candles represent weeks as opposed to days. We just looked at a daily chart, and those candles represented days. These represent weeks, and then we'll flip over eventually to a monthly chart where the candles represent months. All right, so these are weeks. This is a post we put out about 10 days ago or so. The bears have the advantage provided price stays below the line. That line was right around 1360, so we know this has occurred. So we can remove that and remove this. Here's what's interesting, because this is, let's see if I can draw this in while chewing gum at the same time. This is where we got our buy signal in the third week of December of 2011. Once we got above this downward sloping trend line, which at that time was also the 50-day moving average on the S&P cash on a daily chart. So this was a breakout, kind of out of a triangle pattern. We also saw this as possibly a 1, 2, 3, 4, fifth wave higher, but we also said this could be an A, B, C, and then the corrective wave. But in any event, technical analysis is very easy to analyze after the fact, so I don't want to be a rear view mirror Monday morning quarterback here, but this is also to confirm that it does work. More often than not, individual stock, any chart, you go, once you break out, you often come back down and retest that breakout area. And in this case, you could say the breakout was at 1300 because you could make a case for the breakout actually being above this line here as opposed to the downward sloping trend line. But we used the downward sloping trend line when we got long in the 4-minute trader and then started to step in the managed accounts. And again, it all looks easy in hindsight. But technical analysis again worked. We came back. Now we are testing the previous breakout area, the decent breakout area on a weekly chart. I don't think the downside is done yet. We could bounce next week. Anything could happen. But I don't see that it's done. I think the 200-day moving average was the initial target. I think we hit that today, possibly close a little bit below it. But I think 1250 is in the cards. And if we break 1250, then kind of like 10,000 on the Dow, 1200 is a very psychological line in the sand for the S&P. It was on the way up. It's going to be on the way down. And like I said last week, at least in my opinion, if we take out these lows, then I think we're looking at, 900 on the S&P at some point, 950. Now, this could all stop right here. We could just have a little nice 10% correction off the 1419 top, and we could start moving up. But there's a ton of overhead supply here. I'd be very surprised if we got above 1350. And I don't think that this is a low. And the reason I say that is typically, based on probabilities, right, and that's what we're dealing with, is you don't all of a sudden just see a low put in and then it's over. What you normally see is a low, and then you see some time, or what we call white space, on a chart. So we might have a couple more of those yet to go. We'll see. If the trend changes, obviously we're going to get on it. I don't know where that would be, though. It could keep falling. That trend change could be 50 points down from here. It could be 50 points up from here. But in any event, the trend is down. Cash is the place to be. All right, so we're looking at that. But it certainly looks like the obvious area, maybe too obvious, would be that 1250 next. All right, so now let's go to a monthly chart where the candles represent months. And this will back us up to basically 2005. And this is the line that we just drew in. So let's remove that. And these are some notes back from 425. Again, just to reiterate, we could either be in a sideways fourth pattern, which was this, or I'm sorry, in here, where we go higher, or this was an ABC corrective wave. And obviously it looks right now like it's an ABC corrective wave and the top is in. But you know what? We were down 19% last year and we put in new highs. So if you're going to have an opinion, try not to hold on to it. Let the charts dictate the course on a day-to-day basis. But what I wanted to get at here is, remember we talked about space between thrusts. And there is no space here on the up move. And there is no space here on the down move. But you can see basically back in 2008, early 2009, we had some nice thrusts down with some space in between, especially here. This was kind of the shakeout before the breakout. And then really confirmation was when we got above these candles, around 800, 840 in that range. But on the other side of that, hopefully this makes sense to you, we have three thrusts now. One thrust here back in 2010, another high back in 2011, and another high back most recently in 2012. So anytime you have three big moves with space in between, that typically means you're going to go in the other direction, whether it's to the upside here or to the downside here. If you have four thrusts, it's really, really highly probable, provided the space is in between, that you're going to have a major correction. So we'll see. But when we look at this on a monthly chart where the candles represent months, just eyeballing it, old support resistance, we could say on a monthly chart that we have support at 1200. And again, we think if that breaks, then there's a trapdoor below 1180, and then we're going to take out these lows and potentially these lows. I'm not saying that's going to happen, but what we want to do is be prepared for that. In other words, we don't want to get long until we see a confirmation and trend change bullish, and at that we want to have stops in place in the event that trend fails. We want to be able to preserve capital. All right, hopefully that makes sense. Let's take a look at some charts that we had up earlier in the week. Actually, let's go back to a daily chart. There are a couple things that are working. We put up a chart of Disney the other day, and I think we put this up on a weekly chart. Let's go to a weekly. And Disney held up in May. Looks good. This was put out yesterday on a daily chart as well. Stop at 43. Okay, let's go back to a daily. Anything that we get long here or suggest to get long, again, you never want an individual stock to represent more than 8% of your account. That way, if it takes a hit, you can absorb that. Having said that, we're still keeping this stop tight at 43. Let's say that this fails and it breaks a trend line and it breaks support here at roughly 44. Where would we get back in? We would get back in above, and I'll get back in the managed accounts, above this area here. So if it comes down, stops out, and then gets back above that 45.50 area, 45.60, we would get long this stock. All right, that's assuming that it stops falling after getting stopped out. This is another chart we had up during the week. Trail stop 5%. You would have been out of this by now if you took this trade. Again, keeping these stops tight. 100 less 5% is 95. You would have been stopped out of this. Where do I like this chart again? And where do I believe it would be highly probable? If it got above these highs that were put in this week. And roughly that's around $101. All right. What about Apple? We have a stop in there at 559. Again, we did not take these trades in the managed accounts, but we have a stop at 559. What I'm getting at, a couple of things. I want to disclose to you the trades that we put on during the week, where they're at. And number two, where would we get back in the event that you're stopped out if you took the trades. And number three, we want to stress that 3 out of 4 stocks fail when the market is in correction. Therefore, we want the stops very tight and close to support. All right. So from a percentage basis, this is a tight stop. All right. What about other charts that are working? Not too many in the Dow, right? Even if you just had simple rules, dump everything if it closes below the 50-day moving average, you'd be in good shape. Here's a stock here that's above the 50-day moving average. Or you could say, let's buy when it's above the 50-day moving average. And if you experience a little whipsaw above and below the line, so be it. Because an eventual trend is going to wipe out any whipsaw. This is Verizon. This is a decent looking chart. Could it possibly come back down to maybe 40 or even 39.60? Yes. Would I buy it here? No. I would either buy it at an area of support at around 39.60 on a bounce, or I would buy it with a break above this week's highs. Okay, so that covered that. Let's take a look at something that looks fairly decent, and then we'll finish with gold as well. This is JNK is getting smacked down. That's the corporate bond. I'm sorry, the high yield junk bond ETF, JNK. But this is the corporate bond ETF, and this actually is a decent looking chart. This is the LQD. I don't know what dividend this pays, but it does pay a dividend, a yield. But I do like this chart. Close above 117, I think, is a go. And then again, what are we going to do? We're going to use a tight stop, probably just under the 50-day moving average, and support around 115.78, possibly 115.25 would be the farthest we'd park back. That's about 2% at the most, which is well within our risk parameter. All right, let's take a look at a chart of gold, then we'll wrap it up. This is what we put up during the week. I have no fears of anything, but I'd prefer to trade a position that looks less volatile, because this could go either way. Could it continue to go up? Sure. Maybe it was bought today for the fear trade. But when everything needs to be liquidated, it's going to come out of all asset classes, at least related to the markets. So this could go down as well. This is a chart that we put in. We weren't necessarily convinced that this support was going to hold. We think that this is the eventual target. But if this is a bottom, and if you're going to take the trade, and we're at 157.50, have your stop just under 150. Again, that's within that 5% risk parameter. We also talked about gaps being filled. We put out a chart earlier in the week saying that we thought that both upside gaps would be filled, but only one was filled. Possibly we're heading lower without filling that second gap. But again, the whole purpose of this is to stress having an edge, and that edge for us is technical analysis. Not only was that gap filled today, but we came right up to the 50-day moving average. It stuck its head above it and then closed right at it. All right, so that's where we're at, you guys. S&P 500. The market is in correction. Everybody's announcing that it's in correction today because it's below the 200-day moving average or right at it. But we've had it in correction since Friday, May 4th. So we'll see. Try not to catch a falling knife. We're always just trying to catch the fat in between, not the absolute top or bottom. Doug McKay, antiwallstreetguy.com. You guys have a great week, and we'll see you next week. Thanks.